Here are the 3 important stories that you want to tell financial advisors when you get on the phone with them. We don't want to talk about products because when we sit and talk about products with a financial advisor, either on Zoom or face-to-face, they're going to be focused on making sure they're taking notes and gathering that information cleanly and really absorbing the information. When we tell stories to analytical people like financial advisors and they can sit back and listen while that process is happening, they're going to start running through their book of business and thinking about the clients that they have that you as a loan officer can help. So there's a particular way that we get financial advisors on the phone, and that's scripted out, that's taught in the course. But once we've got that financial advisor's attention, again, whether that's on Zoom or face-to-face, we're going to talk about 3 particular stories that help that financial advisor understand how you can help them make more money and how they can start to run through their client list mentally while you're telling those stories. The first one is about financially engineering mortgages, and that's a really important word to use. Financial, like financial advisor, and engineering, which is the only word you really need to pick up on, and mortgages, which is what you do, financially engineering mortgages. What that simply means is, and this is the story that you want to talk about with your financial advisor. Mr. Financial Advisor, Mrs. Financial Advisor, I can financially engineer a mortgage with 5% down in discount points to pay less interest over 30 years versus 20% down at a fair market rate. Now, if you have access to an amortization calendar, it would be very helpful to have those documents with you or email those documents as you're talking about it, not before, not after. Send it while you're talking about it. Have them open up that document or look at it while they're sitting there and look at the total interest paid over 30 years. So if you put on a $500,000 property 20% down, you're going to be borrowing $400,000. If you look at a fair market rate today, roughly 7 3/4, and you look at the total interest paid over time, it's roughly about $630,000. Now, if you take a same $500,000 property, you put 5% down, and you borrow $475,000, and you buy the interest rate down to 6.5%, you're going to pay roughly about $630,000 total interest over time. So the reason why this is important is we can put as little as 5% down and pay less interest over 30 years than if we put 20% down at a fair market rate. Now, at the end of time, when those clients move on from that property, whether it's 5 years, 7 years, 20 years, 30 years, that piece of real estate's worth the exact same. Whether you put 5% down, 20% down, or you pay cash for that real estate, when you go to sell it, that property is worth the exact same. So they're going to make the exact same amount of appreciation on that property regardless of the down payment. So think about it. You could put $25,000 down, and let's say you make 3% per year. That's $15,000 a year. So you could put $25,000 down and make $15,000, or you could put 20% down, which is $100,000, and make the same $15,000. If somebody asks you to invest money with them, how much are you going to give them for that return? $25,000 or $100,000? Same concept. Now, the thing to really think about with your real estate, you can't make that property worth more money with more down payment. It is worth whatever it's worth regardless of what's happening in the market. So the other aspect of that is to think about the importance of your equity in your home. It is not insurable. Your equity is not insured. You can't pick your house up and move it to a different market if you're having local market issues. And if we're having issues nationally and you can't sell your house, you don't have access to more cash to buy more real estate. Some of the wealthiest people in real estate came out of the 2008 crisis because they only put 5% down on their house and they had access to additional cash. They were able to buy more real estate well before anybody else because they parked that capital somewhere else. Now, if you have your assets, minimum down payment in a home, and the remaining portion with your financial advisor, that financial advisor can move that money around through the markets and protect it. So you can jump to bonds, you can jump back to markets, you can go into money markets, you can go into fixed investments. The market can tank, you can rebuy at a low point, ride the market back up. You have way more flexibility to create way more wealth for your clients and correlate to a financial advisor's business model when you think the same way. That's the first story that you want to talk about with your financial advisor. The second story that becomes very beneficial for deepening a relationship with a financial advisor are reverse mortgages. But reverse mortgages have a new term in today's market called a HECM, or Home Equity Conversion Mortgage, HECM. A home equity conversion mortgage is an insurance policy for somebody that's in their older ages that don't want to entirely rely on their retirement assets in order to pay for their living expenses. Here's a really simple correlation. Let's say somebody has $1 million in their retirement accounts. In conjunction with that, they have $100,000 annual living expense or carrying costs to live the lifestyle that they want. For every year, they need to borrow 10% of that total asset in order to live. If the markets drop and that asset goes to $500,000, that $100,000, which used to be a 10% correlation to that total asset of $1 million, is now a 20% correlation to half of the value of $500,000. So if they have $1 million, the financial advisor can work diligently to make sure they get a 10% return in order to pay their living expenses. But if the market drops, the financial advisor's income's down. And that homeowner's expenses remain the same. If they have to borrow that $100,000 against a $500,000 asset value, that's a 20% return. That's really challenging for a financial advisor to continually earn on his client without being deeply integrated in that client's portfolio. So if he's got 100 or 200 clients, it's nearly impossible to manage those assets that well. So with a home equity conversion mortgage, we build in an insurance policy for that homeowner/investor. Now we're protecting the financial advisor's assets under management, and we're not depleting the homeowner's assets to the point where they're going to run out of money. If their asset's worth $1 million and the advisor can earn 10% return, they can live off that. If the asset drops to $500,000, they can borrow $50,000 from that asset, which is the same 10%. Now they can tap into the home equity conversion mortgage for the other $50,000 and continue to live that same lifestyle without wiping out their assets. So that's story number 2. The third story is non-QM mortgages. We're talking about bank statement loans, asset depletion loans, asset ratio loans. These are all of your non-QM wholesale type products. In order for you to better understand how those products can be utilized in these relationships, a second thing that you can do is call those wholesale lender reps and have these conversations with them. But what's beneficial for the financial advisor is you're going to tell stories like how you helped somebody get access to a mortgage who recently went self-employed in the last year, who doesn't have 2 years of filed tax returns, or the individual self-employed client that has been self-employed for several years and is running their business at a loss because they're growing every year. These are things your financial advisor needs to hear stories about, not the product details, so that he can, again, go through that process. One of the stories that I use quite often is I actually have helped professional NFL players and MLB players get access to financing who have recently come into a signing bonus or some type of contract where they get a big lump sum of capital. The challenge is they have no work history, or they don't have the work history or the income in order to support the traditional ways in order for these clients to qualify for a mortgage. So we use asset ratio lending, where we take the asset, look at the face value, subtract out the down payment, subtract out the reserve requirements for PITI, principal, interest, taxes, and insurance. Whatever's left over in their retirement assets, we can match in the loan amount. So let's say they have $10 million. They're going to put down $1 million on their new property. They need to take out another $500,000 in reserves. Whatever X amount of dollars is left over in that asset, we can do a 1-to-1 lending ratio. If that doesn't work, you can do asset depletion, where they take a different face value of the asset and divide by 60 months in some cases, 80 months in other cases, and sometimes 120 months, and whatever that amount is becomes their monthly income. There's also community lending, where you just have a down payment, you don't put any job in there, you don't put any details, and because it's a primary residence, you need 20% down. Now, the rates may not be that attractive, but this is where you need to talk about paying discount points or really keeping as much assets in control with the financial advisor that you can, because the equity in your real estate is not insured. So there are other ways to create more wealth for your clients, but you have to talk about stories and how you've helped people. And if you haven't particularly helped an individual do that, then just say, my office has been doing this, or we've been using this product in the market in order to help these types of people get these things accomplished in their life. These are the stories you tell financial advisors so that when their clients are talking to them, or they're sitting down and watching corrections in the market happen, they start to think about the stories. They're not going to think about the product because they're not loan officers. So remember, we've got a specific way we get them on the phone or a Zoom call or a face-to-face, and then when we sit down, we simply say, Mr. Advisor, Mrs. Advisor, I just want to tell you 3 stories that I've used in the past in order to help financial advisors create more wealth for their clients. And we're doing this purposely to keep more assets under management. Then go into financially engineering mortgages, use the HECM story as an insurance policy, and talk about your non-QM products as being a way to always find types of financing where the advisor or the client thinks they need cash. And that's it. Keep it simple and enjoy the process. And when you're in those meetings, it's not about impressing them to hope you can get their business. It's about interviewing them to see if they're a good fit for your business. Because with rinse and repeat models, you can find people that you enjoy being around and that you love to work with that are going to help you flourish to success quicker than you trying to wear that mask and entertain everybody that you talk to. So be selective and make sure that they're a good fit for you.